Howdy, Jacob here. Today we're looking at Carriage Services in the diversified consumer services industry. 473 million market cap with over double that for enterprise value. Founded in 1991, they provide funeral and cemetery services. So I have a possible thesis that this enterprise value is so much greater because of capital leases. And I was proven wrong. All right, long-term debt, $580 million in relation to $2 million cash on hand. I will say I do think cemeteries get a bad rap, and I think they're similar-ish to maybe a tobacco company where they don't really always get the premiums that we think they might. I mean, I don't think cemetery services are going in anywhere. I don't see people getting a degree in college or coming out of high school and begging to be in the cemetery services industry. So I do think that there's definitely some stability that comes with this business, and I think stability pushes for consistency, and consistency pushes for premium in my eyes. If you have a business that's growing 3% a year every single year for the last 10 years versus one that grows 10% and 2%, averages out to 3%, I guarantee you people are going to want that 3% a year company more than the other one, all else equal. And so I think just based on consistency, I do think that funeral services have a bit of a premium necessary, but we're not seeing big growth, which again makes sense to me. It's not big, but it's pretty consistent, right? So 2 large growth years from COVID and then dampening down, but I'd be surprised if they didn't grow, 3 to 5% without making big devastations, which I don't really see being the case here. But long rant to say gross margin up a little bit, operating margin up a bit. They do pay a dividend. It is a 1.4% dividend yield, and in relation to earnings per share, looks pretty inconsequential. So we'll see what that is in relation to free cash flow. Not the best return on invested capital, so it doesn't surprise me they pay a dividend. Like I said, balance sheet, allotted long-term debt, $579 million versus $2 million cash on hand. I mean, I'm absolutely concerned about that, even though they are consistent and likely have a lot more consistent free cash bottom line figures than some other companies. I think to have just $2 million in cash with that amount of debt does concern me, because anything can happen, even for a cemetery company. Think about, they have their, I don't know, I haven't looked into the business, but let's say they have 20% land revenue comes from one cemetery and it goes under. I mean, I'm thinking of Joe Greenblatt's. One of his first investments was in a water park or a roller coaster amusement park area, and it literally hit a sinkhole and went under. I mean, it's things that you don't expect that you need to take care of, and when you don't have any cash on hand, it's pretty difficult to come out of those alive. And so that does concern me a little bit, but their cash flow their free cash flow has been positive every single year. So I mean, that's absolutely a positive. Their use of cash is $7 million on the dividend side in relation to way more than that. So that payout is essentially nothing. Mostly acquisitions and a tiny bit of share repurchases. Haven't done so recently though. So a lot of their capital allocation, we're assuming, is going to be going towards acquisitions and a tiny bit to share repurchase, tiny bit to dividend. And then for me personally, I'm going to have a little bit go to debt reduction, because that $600 million in debt, or 579, is about 10 times their 5-year average free cash flow. So it's a hefty amount. And so I will be allocating maybe 20 to 40% of allocation to debt reduction, which is going to, again, minimize what they can do to increase business through acquisition, reinvestment, and then giving money to shareholders directly through share purchases or more directly through dividends. So with this, I will say revenue growth, I think they'll be able to grow 5% pretty single-handedly. That's a little bit of money going to acquisitions, organic growth, inflation. I think that's very reasonable. Free cash flow is quite a bit higher. I love that. Maybe we'll do 12 and 15%. Share change, 1% would be about $5 million a year. I think that they, with stock-based compensation, $11 million. That's, let's say, 20% of capital allocation. I'm fine with that. So that's 1% of shares repurchased a year for the next 7 years. Premium, again, I think consistency is going for them. I think being a cemetery funeral service company isn't, and I think that their debt isn't. So maybe we'll do slightly less than market average here. Dividend in the past, pretty inconsistent with paying it out or with increasing it. So I'll probably just increase it with inflation or maybe a little higher than inflation. We're saying it needs to fall 16% before we get the return we're looking for here. So again, this doesn't take into consideration directly the balance sheet. And so you will have to put in a margin of safety that you're comfortable with for a company that has $2 million cash on hand with almost $600 million in debt, long-term debt. But for me, based on my initial review, we're looking pretty close. So I hope you enjoy the video. Have a great rest of your day. Thank you.